Welcome back, everyone. What if a Bitcoin treasury company just chose a crypto credit instrument instead of treasury bills to support its own dividend payments? That's exactly what appears to be happening right now, and it could signal a major shift in how digital credit is being used inside corporate finance. Because this week, a quiet $50 million decision may have introduced an entirely new type of buyer into the market. On Tuesday, STRC recorded its largest trading day since launch, with 3.68 million shares traded. Every dollar of that activity happened above par, and the instrument is now eligible for ATM issuance. But the most interesting part of the session wasn't simply the size of the volume. The real story was the identity of the buyer participating in it. Earlier today, it was revealed that a Bitcoin treasury company quietly added $50 million worth of stretch to its corporate treasury. This wasn't a short-term trade or a speculative position. Instead, the company positioned Stretch as a yield-producing reserve asset, intended to support the dividend obligations tied to its own preferred securities. That move introduces a completely different class of buyer to the instrument. In this video, we'll break down what Strive actually did, why placing Stretch inside a dividend reserve represents a unique form of validation, and what this development could mean for the broader digital credit model when companies within the same ecosystem begin treating the instrument as financial infrastructure rather than just an income product. This video is for informational and educational purposes only. It is not financial advice, and we are not responsible for any investment decisions you make. Let's start with the details of the transaction itself, because the structure of the decision reveals more than the headline number. Strive didn't simply purchase $50 million of Stretch and leave it as a portfolio allocation. Instead, it embedded Stretch directly into the reserve framework supporting its preferred security, Saylor. Following that change, the company's dividend reserve now contains 12 months of cash coverage plus an additional 6 months held in Stretch, bringing the total reserve protection to roughly 18 months. That distinction is important. Strive is not just another investor looking for yield. It operates as a Bitcoin treasury company with its own capital structure, its own preferred liabilities, and a reputation it must maintain with shareholders. When a firm in that position chooses to hold Stretch as part of the reserve backing its own obligations, the decision goes beyond yield optimization. It becomes a structural allocation inside its financial architecture. In practical terms, Strive is signaling that Stretch is liquid, stable, and credible enough to sit alongside cash in a reserve designed to protect dividend payments. That represents a very different buyer profile than what the instrument has previously attracted. Strive's explanation of the move makes its reasoning fairly clear. The company characterized Stretch as a high-quality credit instrument that offers meaningful yield, strong liquidity, and an appealing risk profile compared with traditional credit options used for moderate duration capital. The yield comparison is straightforward. Stretch currently offers around 11.5% annually, while Treasury bills yield roughly 3.7%. At that difference, a $50 million allocation to Stretch produces about $3.9 million more income per year compared with placing the same capital in T-bills. But the yield gap itself isn't the most interesting part. What really stands out is the benchmark being used in that comparison. Strive didn't measure Stretch against other crypto assets or similar preferred securities. Instead, it evaluated it against Treasury bills, which serve as the standard reference point for safe, short-duration capital in traditional finance. The fact that a Bitcoin treasury company made that comparison and considered it valid is a meaningful signal. It suggests that Stretch is increasingly being analyzed through the lens of credit markets, rather than purely as a high-yield instrument. And that shift is exactly where the digital credit model needs to evolve if it's going to integrate with broader financial systems. Now step back and look at what Tuesday's trading activity revealed. Stretch saw 3.68 million shares change hands, with every trade executed above par, and the session ended with the instrument closing at $100.02. According to estimates from the STRC Live Tracker, the purchasing capacity represented by that session exceeded 2,000 Bitcoin. That's the largest single-day estimate since the instrument launched. Even more notable, the weekly total is already projected to surpass 3,500 Bitcoin after just 2 trading sessions. Throughout all of this, Stretch has closed at or above $100 during every session in March. That consistency indicates that the mechanism supporting the instrument is functioning, and that the buyer base supporting it is broader than at any point in its history. This is where the Strive transaction begins to reshape the narrative. Up until now, most of the discussion around Stretch focused on one central question. Would income-focused investors, both retail and institutional, treat it as a dependable yield product? Based on the growing volume data, that question is increasingly being answered in the affirmative. However, the Strive purchase introduces another question that may be even more significant. Could Stretch become infrastructure for other Bitcoin treasury companies? If that scenario develops, the demand base expands dramatically. The instrument would no longer appeal only to traditional fixed-income investors seeking yield. It would also become relevant to companies building Bitcoin-backed capital structures that require a credible, liquid reserve asset generating income beneath their obligations. Strive has now shown that this use case is possible. Essentially, the company deployed Stretch in a role similar to how some firms maintain cash dividend reserves, as a stability layer and credibility mechanism supporting the financial structure above it. What makes this development particularly interesting is how unusual the application actually is. Stretch was originally designed to attract income-seeking capital from traditional fixed-income markets, investors who wanted yield exposure without directly holding Bitcoin. That remains the core idea behind the instrument, and recent trading activity continues to support that thesis. But Strive has now demonstrated a second application, using Stretch as reserve collateral within another company's preferred capital structure. In simpler terms, this is digital credit supporting another layer of digital credit. That's not just a slight variation on the original model, it represents an expansion into territory that wasn't part of the original design. For an instrument that has existed for less than a year, being considered stable and liquid enough to serve inside a reserve framework suggests a rapid level of maturation. Of course, this structure also introduces a clear dependency that's worth acknowledging. Stretch can function as a cash-like alternative only because it trades around par and produces a consistent yield. That stability ultimately depends on the credibility of Strategy's balance sheet, which itself is tied closely to Bitcoin's value. Strive's treasury model is also based on Bitcoin exposure, so what emerges is a layered structure in which Stretch, whose stability is connected to Bitcoin, is being used as the reserve layer beneath a preferred security that is also indirectly tied to Bitcoin. That doesn't invalidate the innovation, but it does mean the correlation risk inside the structure is real, and it's important to recognize that dynamic when evaluating the system. In the near term, another important moment is approaching. Stretch's ex-dividend date arrives later this week, which historically creates a mechanical price adjustment. In previous cycles, that reset has sometimes produced a short-term dip in the instrument. This time, however, the context is slightly different. The buyer base now includes at least one peer company that committed $50 million as a structural reserve allocation, rather than as a position designed to be actively traded around dividend timing. Strive didn't acquire Stretch to flip the position. It added the asset as a long-term component of its treasury framework. That difference could influence how the market behaves during the upcoming reset. So where does all of this leave us? Stretch has just demonstrated a new application that did not exist a week ago, serving as reserve collateral within another company's capital structure, chosen over treasury bills based on credit characteristics, and held as part of operational financial infrastructure. The instrument itself is less than a year old. It has maintained par during every trading session in March, and the group of buyers supporting it is more diverse than at any point since launch. Whether additional companies follow Strive's example remains an open question. The upcoming ex-dividend date later this week will provide the next important signal, showing whether the momentum behind this instrument is continuing to strengthen or whether it still depends on favorable market conditions. Either way, the developments this week have already shifted the narrative. The role Stretch is beginning to play today looks very different from where it started. That's all for today's breakdown. As we've seen, Stretch is taking on a completely new role in corporate finance, and this could change how digital credit is perceived across the market. If you found this video helpful, make sure to hit the like button, subscribe, and turn on notifications so you don't miss any updates on Bitcoin treasury strategies and digital credit trends. Thanks for watching, and I'll see you in the next video.